Today, I'm on a mission, because I am looking for a good industrial company for my long-term portfolio. And for this, I'll have a deeper look at the dividend aristocrat Caterpillar. After an amazing last year, the company is struggling a bit this year, and the stock is currently trading around 10% below their peak as of this recording. So in today's video, I want to see if their business is in trouble or if this short-term weakness could provide a good opportunity for long-term investors. For that, I will look at the business models and the markets of CAT, analyze their mode, and look at the latest financial statements. I'll also check the valuation to see if now is a good time to buy. My name is Florian, and I use my background as a physics engineer to provide a more scientifically inspired stock analysis on this channel. So let's start at the beginning and have a look at the fact sheets first. Caterpillar has the ticker CAT, and they are listed on the New York Stock Exchange. They are working in the industrial sector and were founded in 1925. At the moment, they have around 150,000 employees, and their headquarters is in Irving, Texas. The market cap sits at $146 billion at the moment. You probably know CAT for the vehicles in the distinctive orangey-yellow color. So you might know already that Caterpillar is the world's leading manufacturer of construction and mining equipment. But did you know that they also own around 20 other brands, like Perkins, where they provide specialized engines like diesel engines and natural gas engines for industrial turbines, locomotives and even ships? Or Solar Turbines, which is a leading provider of energy solutions featuring an extensive lineup of gas turbine-powered compressor sets, mechanical drive packages and generator sets. With these brands, they offer an extensive and globally diversified portfolio that they sell over their extensive dealer network. And this dealer network helps to give their customers top-tier service. According to their company report, this dealer network offers a significant competitive advantage as it can offer local support to their customers all over the world. And even though these dealers are independently owned, they have very long-term relationship and collaborate closely with CAT. So they can provide valuable customer insights back to the company. Around 46% of their revenue is generated in the US, while the remaining 54% are coming from outside the US. So even though the company is operating globally, there definitely is a focus on America. In the next graph, I compared the revenue by segment. And here we see that the energy and transportation sector, as well as the construction sector, both make up around 40% of CAT's revenue each, while the resource business only generates around 17% of their revenue. The remaining 5% are coming from the financial products, where they provide a wide range of financing solutions and insurance services to their customers. Unfortunately, the markets that CAT is operating in, and especially the construction sector, are under pressure at the moment. The spending for construction in the US, the main market, is currently slowing down. Here we see that the growth trend from the last years was disrupted this year and is now pointing down. This becomes even more obvious when we look at the construction for non-residential buildings that make up more than half of the total construction market in the US. One big reason for this drawdown is the currently weakening economy. But this slowdown is most likely only short-term, and in the long run, we see that the global construction market is expected to grow with a CAGR of 6.4%. The construction equipment market should even grow a bit quicker, with around 8.4% annually until 2030. So CAT should be able to benefit from these long-term trends, but in the short run, there might be some bumps in the road. But in order to see if CAT can really benefit from this long-term market trend, we first need to understand how good the position of CAT is in this construction market. So let's check the strategic position by doing the Porter's 5 forces analysis. First of all, I would estimate the threat of new entrants as quite low. The high capital requirements in this construction industry, coupled with the large-scale operations of a global player, make it very difficult for new companies to enter this market. The threat of substitutes, on the other hand, I would estimate as medium. CAT's equipment sometimes has unique features, and the company also offers customization and aftermarket services, which helps them to stand against their competitors. Speaking of competitors, the competitive rivalry in this construction market is quite high, and Caterpillar faces fierce competition from many global and local players. This leads to an intense price competition in this market that is also quite sensitive to economic downturns. The bargaining power of their customers, I would estimate, is medium. Many of CAT's customers are large construction companies or mining operators that often make large volume purchases. This, coupled with the generally easy availability of this equipment, gives them quite a strong position. The bargaining power of their suppliers, I would estimate, is medium to low. CAT's ability to access a large and diverse supplier base for the often standardized components they require puts them in quite a strong negotiation position. Overall, Caterpillar operates in a highly competitive industry with significant barriers to entry and a high rivalry amongst the established players. Its strong brand recognition and extensive global network help it to maintain a competitive edge. In a world with a high demand for infrastructure development, mining and energy solutions, they seem well positioned to capitalize on these opportunities. Over the last year, the performance of CAT was very similar to the S&P 500 with around 26%. Over the last 5 as well as over the last 10 years, CAT could outperform the index easily though. And this doesn't come as a surprise with the growth values of CAT. While the company could only grow their revenue by 3.5% annually in the last 5 years, the net income and EPS are sitting at a very nice double-digit values. The free cash flow, on the other hand, did grow with almost 30% per year during this time frame. This is a bit deceptive though, as it mostly comes from an extraordinary year last year and it will probably come down again this year. And the latest quarterly report from the 6th of August already shows this trend. Their sales as well as the operating profit are going down and only the adjusted profit per share shows some uptrend. This adjusted profit excludes some restructuring costs, however, which are about 10 times higher this year than last year. Profitability-wise, the company can also show some impressive values here with a free cash flow yield of almost 4%, EBITDA margin of 23.8%, net margins of 15.4% and return of invested capital of almost 24%. These values are all higher than the company's 5-year averages and are also sitting quite a bit above the sector medians. One reason for this is that the company could realize some price increases last year, which boosted their operating profit. But I also think that there is a good chance that in the short run these margins will come down again, and over the long term we see the cyclicality of CAT's business not only in their top and bottom line, but also in these margins. Over the long term, the company has stated their goal though to reduce this cyclicality and to generally increase their overall profitability. The clean balance sheet of them will help in this regard, and with a very low long-term debt to EBITDA ratio of only 1.6 times, the company's leverage is well within the targets for my investments. CAT is also buying back shares on a regular basis, and in the last 5 years they could repurchase over 3% of their shares every year. And not only that, Caterpillar is also a dividend aristocrat, and when accounting for stock splits, they could increase their dividends for the last 30 years. But despite this increase, the current dividend yield still sits at a low value of around 1.6%. This is close to the lowest dividend yield of the last 5 years. And it is also despite the company growing the dividend by 8% per year for the last 5 years. Their payout ratio also sits at quite a low level right now of around 24%. But again, I think that this will go up again if the revenue and free cash flow drop next year as forecasted. The target of CAT is actually to return 95% of their ME&T free cash flow to their shareholders. That is the cash flow generated from their machinery, energy and transportation sectors, which are their core segments, as we saw before. I now mentioned a couple of times already that the forecast for next year is expected to drop again. So before checking the valuation and compare CAT to its peers, let's have a more detailed look at the forecast first. The analyst expectations based on 19 analysts are quite mixed. We are sitting almost in the middle of these expectations, with the average price target being only 2% above the current stock price. The highest estimation is around 34% above the current price, while the lowest one is 28% below it. Earnings per share are expected to grow with a CAGR of a bit under 5% annually until 2027, while the revenue should only grow with a bit over 1% per year. But the current expectation is also that this growth is not steady, and in their current year, the revenue is indeed expected to drop a bit before recovering again next year. This growth is nothing to write home about and reflects the tough short-term situation in the construction industry. The latest guidance from the company itself from their last quarterly report also expects a year-over-year decline in sales and revenue. But the situation is better than what they first thought, and in the whole year 2024, they currently think that the free cash flow from ME&T will be in the top half of their target range between 7.5 billion and 10 billion. The adjusted operating profit should also be higher than first anticipated. So the overall situation doesn't seem as bad as they first expected by the beginning of this year. But still, even though the forecast for 2024 is better than initially expected, it will be below the numbers from last year. And this short-term weakness is also reflected in the valuation of the company. The PE multiple sits at 15, the EV to EBITDA at 12.7, and the price to free cash flow at 13.7. All these values are between 10 to 20% below their 5-year averages. So, compared to the recent history, the company seems to be a bit cheaper. And not only that, they are also sitting a bit below the sector averages. Speaking of sector averages, for the comparison with their peers, I choose Komatsu, Volvo, Hitachi Constructions, and for good measure, I also threw in John Deere. Deere is competing with CAT in some areas, but the main reason I put it in this comparison is because at the moment it is one of my top 3 industrial stocks on my watch list. So I want to see how CAT can compare with Deere. Over the last year, CAT and Volvo were almost on par with their performance and by far the best ones from our list. In the last 5 years, CAT was actually the best performing stock of the group, with Deere and Volvo coming in at second place. However, over a 10-year period, the scenario shifts slightly. During this time, Deere & Company emerged as the top performer, with Volvo securing second place and Caterpillar closely coming in at third place. When we compare the dividend performance, we do see some differences, however. CAT and Deere are both very close in current dividend yield and are both the stocks with the lowest yield, while Volvo has with almost 7% dividend yield by far the highest of the group. John Deere could deliver the highest dividend growth on a 5-year basis, while CAT and Volvo have a similar growth with 8 to 9%. From a valuation point of view, all companies except Hitachi are not too far from one another. With a PE of 15.3, CAT is second to only Hitachi, which has a PE of 22.7, according to Tradingview. But please be a bit careful here. As far as I know, Tradingview and Seeking Alpha both use different timeframes for the fiscal years. So these numbers can't be compared one by one, but as Seeking Alpha doesn't have the data here, I think it is a good enough approximation for a comparison. For EV to EBITDA, CAT and John Deere are the highest of the group, with 12 for CAT and 10.3 for Deere. And in price to cash flow, Deere is the cheapest with a multiple of 10, while Hitachi stands out with a very high multiple of 38. I would expect that this is due to some special effects, but I didn't dig too deep into Hitachi yet, so I can't say for sure. If you would like to see a deep dive for Hitachi, please let me know down in the comment section. I'll definitely consider making a video about it. We already saw that the revenue of CAT is not expected to grow too quickly in the next years, and the same is true for Deere, where the growth is expected to be also negative next year. The revenue of Komatsu and Hitachi, however, should grow with almost 15% and 22% respectively. The EPS and free cash flow growth do look a bit different though. CAT could grow their free cash flow very significantly over the last 3 years, but we also already saw that this should come down again next year. The EPS growth in the same time frame was quite high for all of these companies, with Hitachi taking the crown with a whopping 71% growth annually. On a forward-looking basis, CAT is expected to grow the EPS the quickest though, with 18%. Profitability-wise, CAT and Deere also look quite similar. And with an EBITDA margin of around 25% and net income margin of a bit over 16%, they have the best margins of our peer group. Before we sum this up, if you like the video so far, please leave me a like and subscribe to the channel so you don't miss out on my next detailed analysis. And now let's come back to the question, is CAT a good long-term investment or not? The company is a cash flow machine with very good margins and a good balance sheet. They are returning money to their investors by paying a safe dividend and by repurchasing shares on quite a high level. And while the dividend yield is not too high and is actually sitting very close to their 5-year lows, they could grow it with a CAGR of 8% annually over the last 5 years. But the market is currently under pressure, which will make it hard for CAT to grow significantly in the next couple of years. And we already see this in the numbers from the last quarterly update, where the expectations for this year are quite a bit lower than last year's numbers. In the long run though, CAT should be able to benefit from structural changes. These ups and downs are very common in a cyclical industry like the construction industry. And this cyclicality is also reflected in the valuation, which seems very reasonable at the moment. The performance of the last 10 years also was quite good, and the company could beat their peers and also the S&P 500. So the current down cycle could provide a good buying point if you want to enter a long-term position. I am not invested at the moment, but I think it's definitely worthwhile to keep them on my watch list for industrial companies. But please, before investing, do your own research and only use this video as a starting point for your own analysis. And guys, in the current unstable market environment, it is important to keep your long-term focus and not get frightened by short-term drawdowns. So if you are interested to learn about the mindset that I use for my investments in the form of a mini documentary, you might want to check out this video where I go over the 6 most important parts of my thought process. That being said, thank you so much for watching guys, and see you in the next video.